And so let me rewind this. Right now in real time, you're going to see my cursor right in here move around and highlight what we often focus on are congestion boxes to visualize where the market is getting rangy and where potentially you got to be careful long below or short above. And you could see me put that highlight in right there. That's at 66, 67 area. And then I draw a bigger box highlighting the entire range here in the most recent range. So you want to read the real time better, get better at seeing the real time chart reaction and where the market is trying to fight through a top or a bottom. Stop looking at this as a way to see where there's confirmation of great support in here or resistance in here. Once you see it and it's obvious to you, you could almost rest assured it's obvious to most of the rest of the world. You don't want that competition. And so another thing to not only see where it could break out to the downside and either get short, get bearish, or stop getting long is our order flow indicators with, and I don't even want to call them indicators because they're other people's positions along with the anxiety of buyers and sellers. So we put two lines, and when it's green and gray, it's bearish. All right. And you could see it, boom, get green and gray in here, this green line and the gray line. I'm not going to explain for the purposes of this highlight video why, but just know that when too many people, I'll pause it, are long, this green line is longer, and it's green because people are long. You want stuck longs and more people long if you are anticipating and predicting price is going to go lower. Why? Because longs are sellers. Sellers are what you need for price to go lower, whether it's the S&P minis, crude oil, or a house. Got it? Gray is anxious sellers that are trying to drop their sell orders and buy orders that are also dropping, which means buyers are less anxious and sellers are more anxious. That's another dynamic needed for price to go lower. So we're able to summarize it, create the difference, and throw a gray or green line right next to it. So green is long and too many longs is bearish. Gray are anxious sellers for all intents and purposes. That's what you want when the market's going to do this. Or that's what you certainly don't want if you're long and expecting a bounce. And so this breakout isn't just called from the box, the simplicity of seeing what other people see, but they think the opposite. They think the opposite. And you're looking at it as where people are stuck. They're looking at it as where to buy it because it's worked so well and bounced so well in here. And they'll always think that. And the reason is because it's deemed to be easy and people want easy. They want something that's creating a pattern because patterns are easy to recognize. So when the pattern doesn't, the obvious pattern doesn't work is where the opportunities are. And so two-step process, understand congestion boxes, and then also understand stuck longs and anxious sellers always don't just help price go down. It's necessary to have for price to go down.